Happy New Year, everyone, and welcome back to your weekly Forex forecast and market outlook for the first full trading week of January 2026. This is going to be a macro-led weekly outlook. As always, we're going to start with fundamentals and institutional sentiment. Then we're going to connect that over to the economic data and the technical analysis for Forex, equities, and gold. So then you can build out a clean, risk-aware trading plan for the week ahead. So let's go ahead and get started. Let's start off with the bigger picture first, and then we'll move on to these articles. We see that the institutions are entering 2026 constructively but carefully. We see that through the price action and even the data points that came out last week in the beginning or the first trading day, which was Friday. And we saw that 2025 delivered one of the strongest equity years since 2017, which was driven primarily by the AI-led concentration, easing financial conditions, and resilient growth. But we're seeing that January is opening with three friction points that matter. Number one is the geopolitical risk, mainly the Venezuela shock. Number two is the rates uncertainty with the slowing labor market versus the sticky inflation. And number three is valuation concentration within AI dominance and the crowded trades. So this is not the market opening up the year in any sort of panic, but rather in a risk management mode. We also see that the hedge funds are not rushing into size. They're probing liquidity, watching yields, and waiting for confirmation. Now let's take a look at the geopolitical news here. We see that the US capture of Venezuela's president has introduced a new geopolitical flashpoint right at the start of the year. And the institutional read here is that Venezuela is not systematically critical to oil supply. Infrastructure still remains operational, and OPEC Plus is holding supply steady. So there's no escalation that has been priced in yet, and this is not also considered any sort of long-term oil shock. But geopolitics do matter because they inject short-term risk-off sentiment, support gold, increase forex volatility, and create headline-driven flows early in the week. So basically, the institutions are explicitly saying, do not overtrade this event. It's simply a volatility catalyst and not a regime shift. Going off of that, OPEC Plus has chosen to pause supply increases, citing sensitive demand and the risk of surplus. And that tells us two things. Oil prices are not driving inflation higher, and energy is not a macro tailwind right now. That reinforces the broader theme that we have already been seeing in the markets, especially since the second half of 2025. That inflation pressure does exist, but it's contained and it's not accelerating. And that matters for us, especially when we're looking at rates, gold, and equities. Now, moving on to the next article, let's talk about the US economy because this is the core driver for FX and indices. The labor market in 2025 slowed down significantly. We saw payroll growth collapse versus the 2024 data points, hiring cooled, but layoffs did not spike. This is a cooling economy and not a recession, and everything that we have been seeing so far with the data points and the broader themes all point to that. Fed officials, including Philadelphia Fed President Anna Paulson, are framing policy saying that rates are still slightly restrictive, inflation is easing gradually, and labor is bending, but it's not breaking. What that translates to in the market and for us as retail traders is that cuts are possible later in 2026, but they're not guaranteed and they're not imminent. That keeps the US dollar sensitive to data and it's not trend locked. When we're looking at the bond market, we see that it's clearly split, where the market expects 2 rate cuts, but the Fed guidance is suggesting 1 or fewer. Data gaps from the shutdown also are increasing uncertainty and volatility, which means that the yields will react violently to data. USD moves will be fast and two-sided, and FX pairs will respect levels and not the bigger and the retail narratives that we have been seeing on an individual level. This is not a trend chasing environment. This is more of a reactionary market that we're looking at. Moving over to the equities, if you're trading US30 or even specifically NAS 100, we're going to address the elephant in the room, which is AI. AI drove majority of the 2025 gains, but the institutions are now starting to ask some of the harder questions. CapEx is massive, debt issuance is rising, ROI timelines are unclear, and market concentration is extreme. So the question here, which a lot of people have been asking since second half of 2025 is this a bubble? And the institutional answer is nuanced. This is not a dot-com style frenzy or panic. The earnings exist, but upside is becoming harder to justify. What does that mean for us as traders? That indices may stay elevated, but volatility increases, pullbacks become sharper, and leadership becomes more sensitive. That is why historically around this time, we have seen a lot of talk around Santa Claus rally, the second half of December, even going into the first half of January. But this is why a lot of people think, and the institutions think, that this is not guaranteed this year. Now moving over to gold and silver. Gold enters 2026 as after one of its best years since the 1970s. The structural drivers remain bullish here still. You see central bank buying, you see rate cuts later in 2026, and geopolitical risk. But there is a near-term technical issue here. Commodity index is rebalancing. We are starting to see forced selling in gold and silver, and low holiday liquidity that is amplifying the moves. From an institutional perspective, we see that the pullbacks are basically being seen as opportunities right now, but chasing strength right now is very risky. So gold remains a macro hedge and not a momentum trade as well. Now let's go ahead and move on to the economic data points. This week is NFP week, so we are going to be paying a lot more attention to the employment data that's going to be coming out from the US. Starting off tomorrow, we have ISM manufacturing PMI, and that is below 50. If you open up this folder, you see above 50 indicates industry expansion and below indicates contraction. So right now the manufacturing is below 50, sitting in contraction. And then we also have services PMI that comes out later this week too. Tuesday is quite easy in London and New York session. And then if you're trading the Aussie dollar, you have CPI data that's going to be coming out. Wednesday, you have ADP non-farm employment change really kicking off the NFP week. And then you also have the ISM services PMI, which is sitting above 50. And then we also have the JOLTS job opening. So I do expect more volatility to come in around Wednesday. Thursday, you have unemployment claims, but quite easy otherwise. And then Friday is NFP week or NFP day. You have employment data that's coming out, average hourly earnings, unemployment rate, consumer sentiment, and inflation expectations. Now let's start off with US30 on the technical side. What I do want to do is hop up to some of the higher time frames, and I want to map out last year's all-time high level, which seems to be around, say, 48,900. Drop down to the monthly, it checks out. What I'm looking for here is structure and what was the highest point that price tapped into, because we're expecting that we're going to see a little bit more of that volume or that volatility coming into the markets. But like I said, the Santa Claus rally is not guaranteed. It's just something that has happened historically around this time of the year. So if we're looking for any buying opportunities, I'm expecting right now price is sitting around, let's say 48, let's just say 400. So we still have a 500 point move to come back and tap into 48,900 if we are going to be riding off of that momentum, that bullish momentum. From higher time frame, the structure is still quite bullish. And then let's drop down to the weekly time frame, and this is where I'm going to map out my support. And I'm going to do last week's bottom wick projection and then adjust that when we drop down to lower time frames. So I can tighten that or make it wider depending on the price action. When I come onto the daily time frame, I see on Friday that was a massive bottom wick and then push right back up. So I'm going to keep my support here, but this is going to be my range for this week that I'm trading in. And then as I drop down to lower time frames, now I'm going to be mapping out my zones. What that means is if I'm looking for any buying opportunities, then I want price to break above that and then continue back up bullish. As that happens, going into tomorrow's New York session or even Tuesdays, I am looking at approximately 300 points to the upside, and then after that, a continuation up to 48,900. If price rejects that and it pulls right back down, then I'm looking for sell opportunities as price breaks its own low. There's a bit of a gap that it seems like the market has created right at the open. So I'm going to give it some room. So I'm looking at the candle bodies right here. If price can break below that and then continue back down, then we're looking at another around 400 to 500 point move to the downside just to stay in this lower range here. Drop down to the 4-hour time frame. This is where we see that gap. It got filled in almost immediately. a little bit of a top wick, didn't necessarily break the previous top wicks here, so I'm going to give price enough room to break its own low, and we have a little bit of consolidation right below this zone, so clear out of that and then continue back down bearish. And then as that happens, then we look for our sell opportunities to the downside coming into 47,800. And as you can see historically, we have some clean moves that we can still copy here, but I want to stay out of this little bit of consolidation. Let's come over to GBP USD. Same thing, hop up to a higher time frame, and then last quarter, or even last year, this is the high point that price made back in December, and you got 1.355. Drop down to the monthly, you see that top wick rejection, price is sitting right around here in December, and then already we made a little bit of a top wick. Drop down to the weekly time frame, and what I'm going to do is map out the support right here for all of this consolidation, which is that bottom wick rejection for last week. Let's just call that 1.34. Drop down to the daily. Here, it seems like we have those clean sell opportunities if price can continue breaking the previous daily low to the downside. When that happens, right now we're looking at a range of about 34, around 30 to 40 pip range. What I like to do personally is treat GBP USD and Euro USD, so the major pairs, as my swing trading opportunities rather than scalps. This is more of like a scalp move for me. And price is sitting in the middle of this range that I have mapped out from higher time frames. So that means that there's no trade here until price can come back down into the support, reject this, hold on to a support, basically treat this like a retracement, and then continuation back up. If that happens, then that is my swing trade buy to the upside from 1.34 up to 1.355. But right now we do see that the US dollar is gaining more strength because of the geopolitical news that we see, especially with Venezuela. So if price continues to break below this level right here, I want to see a retest. Same thing, we have consolidation right below this area. Even though it is on the daily time frame, I still want to be a little bit more conservative since the year just started. So if price can give me a retest of 1.34 and then push back down further, those are going to be my swing sell opportunities. Otherwise, I have my buys to the upside, or we just wait until price gives us a clear direction of where is it headed. Is this simply a retracement, or is it going to break structure? Euro USD tends to be quite similar to GBP USD, but we'll still mark up the levels. Last quarter, since the last 3 quarters, actually, price has not broken above this level, so that tells me that this is a pretty strong level, and we need fundamentals to be on our side to really break past that. I'm going to drop down to the monthly, and I see a bit more of a consolidation here on the monthly. Drop down to the weekly time frame. What I'm going to do is map out the support, which is going to be these candle bodies right here. And then right below that, you have a little bit of consolidation. So I'm giving price enough room to consolidate or just do a lot of wick rejections, fake outs, whatever it wants to do within this range. It's pretty big, but it's enough to be safe and not really get stuck in any sort of fake out. If price breaks below that, then it's a clean move and a clear move coming right back down into this level right here. And that could be a swing trade that we can take to the downside for about 174 pips to the downside. Anything in between this is simply going to be any day trades or scalp opportunities. And then here as well, we see that anytime price taps into this level, you see a nice sell-off, came back, another sell-off, came back, a quick little fake out, another sell-off to come right back into this area. And then now we have revisited that area. So that's why I want to see if price can break below this. If it does, then we know that it's coming right back down into that 1.15, which seems to be a liquidity area given the volume that tends to follow right after. If price holds onto a support here and then continues pushing back up bullish, then I will entertain a buy opportunity from here up to 1.18. So price basically needs to be close to either a support or a resistance prior to entering a trade. And then if price can continue breaking past that 1.18 area and then continue back up, then I'm looking for scaling opportunities up to 1.19. Let's come down to GBP JPY. Same thing, go on to the quarterly. GBP JPY has broken some of these previous historical resistance levels. So we're sitting at a current all-time high for the current price action here, which is 211.8. drop down to some of the lower time frames. On the weekly, we had a nice little consolidation, and then, or monthly, we had a nice little consolidation and then a rally up. Let's drop down to the weekly. And then same thing here. After that consolidation, you had a bit of a retest right here and then a push back up. And then last couple of weekly candles, we see some bearish candle closures here. So not a lot of seller's pressure here just yet. But what I will do is map out the support here on the weekly time frame, which is 110.1. Come on to the daily, and then we start to see clear consolidation here. So once again, it's sitting in the middle of the range here, so this is not going to be a trade opportunity for me. For any sells, I want price to break below 110.1 or come close to the support here once again at 110 or 210.1, and then look for those buying opportunities, that range to range trade, or push back up into 211.8, and then look for sales to come right back down into 210.1. So those are the only times I'm going to be looking for any buys or sells here. And then for swing trades, I want price to break past 211.8 or break below 210.1. Let's come over to USDJPY. So I would scalp or day trade US30, GBP, JPY, and gold. And then these two pairs here would be more for my swing trade opportunities, since major pairs do tend to move a lot slower compared to the other assets. Now, when we're looking at USDJPY, it seems like it's sitting at historical highs here once again. And then we have a top wick rejection here from last year at around 157.9, or you can even do 158 flat. You come onto the monthly time frame, nice little push up, and then last monthly candle or December's candle closed out with not so much of a bullish volume, but still bullish here. Come onto the weekly time frame, and then I will map out bottom wick rejections. So not here, you can move it down here if you like, but I'm going to keep it a little bit tight, but enough room for price to reject off of 157.9 and then look for a harder sell-off to come back into 155.6, or price to push back down into 155.6 and then push right back up to 157.9. Drop down to the daily, and we see a lot more price action here, candle closures, quick little pushes after price taps into around, let's say, 154. So if price does reject off of 157.9, there's a very high chance that we will follow what price has done here previously, tapping into this 154 area. So if price can reject off of this once again, push back down, then potentially coming back into that 154 area here. For harder sell-offs, for swing trade opportunities, turn day trades into swing trades. And then right now, I don't really have a trade opportunity, but if you were scalping this, then you would just wait for price to break above, let's say 157, and then run that up into 157.9. And now finally looking at gold. We've got a rejection off of all-time highs. The projection for last year was that price was going to tap into around 4,500 or even 4,900. So we did definitely tap into that 4,500 and then rejected off of that. The projection is that we're going to see those continued geopolitical risk going into even the second half of 2026, and we might see that gold runs up to around 4,900. Those predictions were from JP Morgan, Goldman Sachs, and some of the other bigger banks last year. So if you go back and look at their economic outlooks, you'll see that in there too, from December 2025, or just 2025 in general. And then we see that price rejects off of 45, 46, pulls right back down. And now let's come on to the weekly time frame. Last weekly candle came back and closed bearish. So what I'm going to do is mark off the bottom wick rejection here, which is 4276.3. So if price can break below that, then we're looking for harder sell-offs to come back down into that 4,000 mark. And then if price simply holds on to a support here and pushes back up, then we have a pretty good range to look for any sort of swing trade opportunities here. Same thing for gold. Price did gap up, but of course that's given the Venezuelan news that came out. And so what we're going to look for any sort of scalp opportunities is price to break above this zone and then continue back up bullish, targeting 4,500 and then 46 area. rejection off of that, pull back down, or if price continues, then you scale in after price holds onto a support at 46.6 level. So overall, we have a really good week that is setting up. Like I said, this is not a trend chasing environment. This is more of a reactionary market. So the institutions are not swinging big size this week, and we're not doing the same thing either. We're going to wait for confirmations, and then we're going to look for our entries based off of higher time frames and lower time frame alignment. The institutions are watching yields data, watching how markets will digest Venezuela, letting price come to levels, and they're prepared for no trade scenarios. So that's exactly what we are going to do as well. We are not going to force any sort of trades, and having a no trade day or no trade week is completely fine if you don't see setups that align with your A+ setup. So your framework for this week and what we are going to be following in Sharma FX is we're not trading any sort of headlines. We are not forcing bias. We're letting price confirm macro, respect higher time frame levels, and accept that not trading is completely valid this week. This is a reaction week. It's not an anticipation week. And just to close out, the reason why I teach weekly outlooks this way is because I'm building a 12-week accelerator where the traders learn how to do this themselves. You will learn how to read macro properly, understand sentiment, align structure, and build your own trading framework. So there's no more signals, no more copying trades, no more guessing what the market will do. Simply a process that works for you and your style of trading. If you found this helpful, take your time with the charts, map your levels, and remember to always follow structure over retail opinion. I'll see you guys in the next update.